cover today, I'm actually going to break it into two sections. So Russ has really set this up well. The first is going to talk a bit about the shrinking UK equity market and whether that's a challenge or an opportunity, because the FCA is doing a consultation on ways to improve the market effectiveness in the UK, essentially to attract more companies to list in the UK. And that could be an opportunity, that could be a threat for investors, but let's talk about that. And then the second half, really a whistle-top tour of the Merchants Trust, very quick introduction and simplified. There's a lot more information on Merchants Trust at our website, merchantstrust.co.uk, and in our investment report and accounts, which has won an award for the last 3 years consecutively for the best report and accounts in our sector. So very pleased. If you want to get more information, we can, but I'll give you a whistle top on that. Let's go straight into this shrinking market opportunity or challenge. So the FCA is doing this consultation, and what they're saying is, if you look at the number of companies listed in the UK, it's fallen from about 1,400 12 years ago to about 1,100 today. That's the thin red line. And actually, the market value of the UK market has stagnated. Russ talked about this. And there's lots of reasons why this might be the case. We've had arguably growing regulatory burdens on companies listed compared to being private. We've had clearly a massive rise in private equity and companies are able to get finance elsewhere. They don't have to come to the public markets anymore in ways that they used to. There's questions about whether there's a lack of innovation culture in the UK, a lack of investment in the UK. We've heard about the productivity decline or lack of productivity growth. To some extent, stagnation in the economy since the financial crisis. One of the reasons why interest rates have been so low, not just in the UK, but globally, has been because of lack of real economic growth. And of course, can't avoid the B word. Brexit has definitely been throwing that up as a risk or a problem in the UK, and a reason why companies might not want to list here or investors might not want to invest in the UK. I think the flip side of all of that is you still have a very open market in the UK. We're very open to takeovers and corporate activity, and we've seen a lot of takeovers, and I will come back to this later. And one of the flip sides of a lowly rated, out of favour market is the fact that we're seeing a takeover. And of course, that reduces the number of companies listing in the market, but it can also be an opportunity for investors. So one of the really interesting charts the FCA has given is a 60-year chart on the UK. It's quite complicated, I'm afraid, but essentially there's been two big themes in the last 60 years. If you go back to the 1960s, more than half of the UK stock market was owned by private individuals, private investors. That's the grey chunk here. And that is now down to just over 10%. So you've seen a massive decline in private ownership of the stock market. And then the other big trend, really peaking in about the 1980s, 1990s, is about 50% of the market. Half of the market was insurance companies or pension funds, domestic UK insurance companies or pension funds. They owned half the market, and they were the dominant investors when I started my career. And they've now dropped to about 5%. So they've been gradually selling UK equities and going overseas. And meanwhile, the slack has been taken up by international investors, the blue bar in the middle here. Now, why that matters is because if you're an international investor looking at the UK, you're only really going to buy UK companies when they're interesting, when they're differentiated, when they're something compelling as an investment case, perhaps, or if they're incredibly cheap, maybe. But of course, international investors also tend to be more worried about political risk, about Brexit, about political instability. So those flows can be quite flighty, they can come and go. And therefore, we've become a market that is more sensitive to the whims of international investors and more sensitive to political risk as well. So it's quite interesting. And again, that can have advantages if you're at a time when valuations are quite depressed. So if we look at some of the other challenges companies have got, I think we know we're in a difficult economic environment. Russ touched on this earlier. We've got potential risk of a recession. We've got rising interest rates. There's lots of bad news around. If you speak to companies, they're worried about where demand is going to go. That's uncertain. They're worried about rising interest rates, cost of debt, the availability of debt, even in some cases. Deglobalization is a big trend. Companies spent 15, 20 years, maybe longer, moving their supply chain to just in time, to the cheapest place around the world. And they've realized during the pandemic, particularly, that actually there are issues about security of supply. Political risk is rising. Companies need to have more of their production near where they are. And so you're seeing deglobalization which is leading to higher costs, higher inventory, duplication in some cases. That's a challenge. And of course, labor costs are rising. So there's a lot of risks out there for companies, a lot of potentially bad news. Having said that, many of the risks, many of the issues are rolling over. Energy costs, oil prices have rolled over on a 12-month view and are coming down. Freight costs are coming down, and bond yields might have peaked. So some of those challenges might be gradually easing a bit. And of course, what you have seen though is investors flying away from the UK. The chart on the bottom is flows into equity funds, or in the UK. There's been a lot of money going into global funds and a lot of money coming out of UK equity funds over the last sort of couple of years. So we've seen big outflows. The good news of that is the UK market's quite cheap, and I'll come back to that in a minute. And cyclical companies where there are more risks, economic risks in particular, are priced really for recession. They're priced quite cheaply within that. So, and you've got this enormous dispersion, which I'll come back to now. So a lot of bad news has already hit share prices. And that's shown in these two charts, which are probably most important charts I'm going to show you all evening. The one on the left shows the valuation of UK companies compared to other companies around the world. It's from MSCI, and it's based on a number of different metrics, different measures. UK companies are trading at about a 40% discount to the world average. That is unusually high, unusually big discount for all the reasons I've talked about, all the concerns about Brexit and political risk. And that is potentially a great opportunity for the UK market. And on the right-hand side, you've got the gap in valuations between higher rated companies, higher valued companies and lower valued. That gap is as wide, when that number's negative, that gap is as wide as it's ever been. I started my career with the late Tony Dye, who used to talk about valuation with a company a bit like pulling an elastic, a brick on the end of a piece of elastic. And as you pull the elastic, the valuation dispersion gets bigger and bigger. Now, some people will say, that's great, I can keep pulling forever, and that's I should gain confidence that the valuation doesn't matter anymore. The more I pull, nothing happens. But of course, we all know at some point that brick can move, and when it does, it can move very fast and come and hit you in the face. So that gap in valuations tells you there's a lot of potential opportunities in the market. Many really good companies have perhaps been oversold because foreign investors aren't looking at the UK in such detail. There's been lots of reasons not to own the UK, and you're seeing a great gap. So the companies that are internationally competitive, seen as best in class, big companies like Unilever, Diageo, they're not necessarily particularly cheap compared to their international peers, but many of the domestic ones that are less usual or more unusual are potentially quite interesting, and we're seeing lots of opportunities. So is the glass half full or half empty? We think actually this aversion to UK and to some of the UK companies means the glass is half full as a stock picker. There's lots of opportunities out there. Which brings me, one other thing, sorry. There's a lot of comment about the UK, but it's not just a UK phenomenon. If you look at the World Bank website, you can see that actually there's been a shrinkage of the number of companies in many other markets as well. You don't hear this very often, but the number of companies in the US, listed in the US, has declined dramatically actually in the last 10, 15, 20 years. And you're seeing a similar picture in Germany and France from a much smaller base. So it's not just a UK phenomenon, but I think the reason why the UK stands out is because we've had a lackluster market. The market's not really gone anywhere. We haven't had any of the mega cap tech stocks that have driven, for example, the US market. So it does look like the UK has been quite unattractive to investors, but many markets are suffering from similar trends in the number of companies. So it's not just a UK phenomenon, which does bring me on to my second area, which is the Merchants Trust. So delighted to talk about the Merchants Trust. It's an investment company that's been around for 134 years. And there's a few, we invest predominantly in large cap UK equities to derive a high yield and a rising yield over time to pay shareholders a good return and a good income. That's the objective. And we have, I'm very pleased to say, we've raised the dividend, or I should say the board has raised the dividend for the last 41 years consecutively, and still have significant reserves to keep doing that. We've got a strong performance record, if you like. Despite that high yield and that dividend growth, we've delivered good returns with an active stock selection approach, which is very much value driven. And Russ talked about valuation driven approaches earlier. And we have a low management fee, one of the lowest in the sector, and a low ongoing charge. as well as a strong independent board of directors, which, like all investment trusts, is there to represent shareholders and to look after your interests. So moving on to the objectives of the Merchants Trust, the first is to deliver a high and rising dividend. We've managed to do that for 41 years in a row. One of the great features of an investment trust is the board can put money away in the good times when the sun's shining to keep paying dividends in the tougher times when it's raining. And the way we show that on this chart, with the green bars being the years when the directors put money away into reserves, and the red bars are where the directors have used those reserves to keep topping up the dividend so that shareholders see a growing income stream, even when the income we're receiving in the market from companies has declined. And a really good example of this is during the pandemic, where you saw in 2020, 2021, the income we received, I should say our year end is January. So when we say 2021, we mean almost calendar 2020, which is the year where dividends were cut quite sharply in the pandemic from many companies. Our income as a trust was significantly impacted in 2020 or fiscal 21, but the directors topped up the payments from reserves, did the same to a much lesser extent last year, and I'm delighted to say in the year that finished this January, we were able to once again cover the dividend and put money way back into reserves. So to continue that program of growing the dividend every year. And the reserves at the end of the year were about 16 pence, just over half a year's dividend in reserve. So there's still more for a rainy day, but hopefully we are on an improving trend. The second objective is not just to pay a high dividend, but to deliver a good total return as well. And we show here in the blue lines the total return, both at the net asset value and at the shareholder total return over the last decade. And we compare that to the benchmark, which since 2017 has been the FTSE All Share Index. And we've delivered a return well above the benchmark for shareholders, as well as delivering the high income objective. So we're very pleased with the performance we've delivered. It's actually been, as an aside, a very difficult environment for value investors for much of that period. And despite our value approach, we've delivered strong returns, which really comes back to what we mean by value. Value for us isn't just about buying companies on low valuations. It's about buying good businesses, which meet three criteria really, which I've shown at a high level on this page. Essentially, we're trying to buy strong businesses with good fundamentals at a sensible valuation with an attractive thematic background. Let me go into that in a bit more detail. Fundamentals are, do we think the industry is attractive? Has the company got a strong competitive position? Has it got a robust balance sheet? Has it got a strong management team? How are they incentivized? All this stuff you would expect us to think about and understand in terms of, is this a strong company to invest in? And in particular, these days, we're looking very much at the environmental, social and governance risks and making sure we understand those and think about those before we invest. On the valuation, we're looking for companies that are priced below what we think they're really worth. Doesn't mean they have to have a low absolute valuation, although that helps, but we want companies that we think are worth more than they're priced at. And we look in particular at cash generation and their ability to pay to generate a lot of cash even after the cost of running the business, what we call free cash generation. But we look at asset backing, we look at other valuation measures as well. And then the third thing, which I think has kept us out of a lot of problem situations and has helped us a lot, is to think about what's going to change. We've got good companies that are cheap, but what's going to change going forward? We call this the themes. We look at demographic changes, digital trends, what can happen in the environment, what can happen to the outside world that can affect this business. And ideally, you want a good company that's cheap with supportive themes. Perhaps best to give an example. I like this example because it's a lovely picture of a dog on the front. But this is a company that we bought in January this year, Pets at Home. You'll probably know, if you've been down the high street, the big green stores, which have bunny rabbits in them and fish in them and pet food. They're the market leader in pet sales in the UK. And that's a good place to be. Their scale gives them an advantage. For example, they can develop their own brand of highly nutritious pet food, which is much cheaper than the main brand, but actually the company makes as much money, if not more, when you buy that. But it gives them a lot of scale. They got a strong competitive position. But on top of that, they own one of the country's leading vet practice groups called Vets for Pets, which is a joint venture business, a unique joint venture business. And that's really the hidden value or the hidden jewel in the business. It only makes up about 10% of the sales, but it's incredibly highly profitable because they're taking a joint venture revenue stream. It makes up about a third of the profits and nearly half the cash flow. And there was an opportunity. So it's a strong business. In terms of the themes, you're seeing various themes in that industry. Humanization of pets. People are treating pets more like people. They are giving them much better healthcare. They are operating on pets if there's a problem. They're giving them clothes. They're buying them highly nutritious food, toys, all sorts of other things. People have their pets in their homes rather than just in their gardens. So there's a humanization trend, which is very good for the marketplace. There's a premiumization. People want better products for their pets. And there's also resilience. These are economically resilient categories. People do not cut back generally on spending on their pets unless they absolutely have to. So it meets some interesting themes. And then on valuations, we were buying this share when the shares were quite depressed earlier in the year. People were a bit more worried about the retail outlook. And there were some reasons why the shares were quite cheap. And we didn't think they at that time reflected the valuation of the vet business in particular. I'm not making a forecast, we're not giving a recommendation, but I just want to explain why we bought it at the time we bought it. So it was a good company, it has strong fundamental themes, and it had an attractive valuation when we bought it. Just coming back to linking the first half of the presentation with the second half, I said at the beginning we've seen lots of takeovers in the market. In our portfolio, we've actually seen 10 takeovers in the last 6 years or so, since the Brexit referendum, in fact. And it's really a sign of the fact that the UK is open for business, for takeovers, and there's some really interesting companies out there. And if you can identify strong businesses that are underpriced, you may well have a takeover of them. We've had 10 of them, which is in a portfolio of 50 stocks, it's 1 in 5 effectively over that period have been taken over. And it just links what I was saying about the shrinking market, why it might be an opportunity if the market is lowly priced, if you pick the right companies, as well as a challenge. I'm not saying we're going to see this many in the next few years. This is highly unusual, but we are still seeing great value in many companies out there. Just to talk about some of the themes that we are exposed to. So I talked about the pets theme, the nutrition and well-being. It's not just pets, actually human nutrition. Companies like Tate & Lyle making specialty ingredients are benefiting from a similar trend. But if you take the energy transition, many companies are exposed to the energy transition, whether this is companies that make copper, which is a critical material, or companies like SSE and Drax, which are generators building renewable power generation. And there have been times to get exposure to many of these companies at attractive valuations. So we are not losing our valuation framework, but if we can find companies with exposure to these themes, that's quite interesting as well. So really, that's what I wanted to cover. There's a lot of other themes here, a lot more on our website to talk about, but just to sort of round up and remind you what I said at the beginning, Merchants Trust is trying to deliver a high income stream and a rising income stream as well as good total return. We're doing that by being active stock pickers in the UK market with a value discipline. And I don't think there's rarely been a better opportunity to be a value investor in the UK, because foreign investors, and linking the two together, foreign investors are generally very picky. They like the very well-known best-in-breed companies in the UK, and they're not often looking in the small and mid-cap areas or some of the other parts of the market where there may be great opportunities for stock pickers. You've got this highly polarized market with great opportunities, and we're finding really interesting companies to invest in with our value approach. And we have a very modest management fee, ongoing charges 0.55%, which is one of the lowest in the peer group, and a strong independent board. So with that, I'll hand back to Russ. Happy to take questions later on, and great to speak to you all tonight. Thank you.